To me, it's almost comical that he'll sit there and he'll say that we're going to eliminate the IRS because we're going to be making so much money with all of the taxes that are being generated from the goods that are being imported into the United States. That's the way it's being sold, right? And 5 seconds later, he's going to tell you how tariffs are going to make American manufacturing so great that it's going to completely eliminate imports. Last time I thought this one through, if your tax revenue is based on imports, tariffs, and if you reduce the tariffs because they're successful, right? Because you're reducing imports because manufacturing is booming in the United States. Well, at the exact same time, you're reducing revenue to a point where if you really achieve your objectives and make the United States completely self-sufficient, you would literally have zero tax revenue. I'm not saying that's bad. I'm not for taxes, but that just shows another one of these contradictions that Trump makes that makes it so difficult to predict what the hell he's going to do. If the economic activity is increasing, if it's risk on in the real economy. I'm not talking about risk on in the stock market or the fart coin. That's completely different. Banks are obviously going to have a huge incentive to lend into the real economy because they're going to get a better interest rate than just holding on to treasuries. And that net increase in lending is going to be a net increase in money supply, because I'm sure your viewers are familiar with this concept, is that when a bank creates a loan, they're creating new money. They're not taking money from over here and sending it over there. If you have more loans being created than are being paid off, then you are going to have a net increase, all else being equal, to the empty money supply. Where if more loans are being paid off than are being created, empty money supply is reducing. So you use that as a proxy for lending, and then you use lending as a proxy into the real economy as to the health and the risk-taking of the entrepreneur and the banking system at large. So that's why, among many other reasons, why you see money supply decline in times of recession or outright depression. Now, we haven't seen the decline. I should say money supply growth decline. So during the GFC, we saw money supply growth flatline. So it wasn't a nominal decline. It was just a decline from the overall trend, which is what you would expect. But to your point, there are a lot of metrics out there that show the economy is getting weaker. I mean, we triggered the SOM rule. We talked about the inversion of the curve. And usually when the curve steepens out like it has, that's usually when you have a recession going back to, let's just say, the 1950s or so. There's maybe one or two exceptions to the rule, but you're batting about 90% there. So again, there are no certainties. There are only probabilities. Regardless of what Trump does, the economy was softening prior to him getting into office. So what he is doing, can he offset that to the point where you have a soft landing? Maybe, but I would also look at what's happening in the global economy and understand that that will likely impact the United States. Today, we live in a not just globally connected economy, but the monetary system is completely interconnected. In fact, I was talking to Mike Maloney about this, and he had a chart in his most recent book where he goes back and looks at the United States going into recession and then see how many other countries went into recession as well. And he goes back to like the 1970s. And in the 70s, you see like 60% of the countries going into it. And then you fast forward all the way to the GFC, and it's like 100% of the countries went into recession. And his theory, which to me it makes a lot of sense, is because the monetary system is now so interconnected, and the financial system and our economies and our supply chains and whatnot are so interconnected that if the United States or if China or if the global economy suffers, it's almost impossible for one of the major economies in the world not to have at least a recession. So you look around at China, and most Americans don't even realize this, but China is literally going through a GFC right now. They're battling deflation, the bad type of deflation. Their housing market has come down by 35%. And you say, oh, well, that's not a big deal. Well, yeah, it is, because 2 years ago, the Chinese real estate market was the largest asset class in the world, bigger than the stock market, the US stock market. And it was valued at around 60 trillion. So if that thing takes a 30% hit, then what that means is that the balance sheet, the purchasing power for the Chinese society at large goes down by $20 trillion. We have to differentiate between the stock market and the economy. There's almost an inverse relationship now, where the worse the economy gets, the better the stock market is, because that means the Fed's going to cut rates. It's the whole bad news is good news thing. And so you look around, and it's not just China. I mean, you look at what's happening in India, you look at what's happening in Germany, you look at what's happening in the Eurozone, in Canada. These economies are contracting. If you're a Japanese investor, where are you going to put your money? Especially when you look at the last 10 years and you see the dollar double in value relative to the yen. And you say, oh, George, well, that doesn't matter because all currencies are going down. It's just the dollar's going down at a slower rate. No, it's not. That's a very American-centric view. It's not reality. So if you think about this, let's just say that the dollar increased against the yen by 100% since 2014. Okay, well, you look at the inflation rate since then, or you look at how much the price of goods and services has gone up denominated in yen, and it's not 100%. So let's just say it's 50%. What that means is if you're a Japanese citizen and you've held dollars, then those dollars have increased in purchasing power, not just relative to the yen, relative to stuff you buy every single day. I've been here in Colombia for 10 years. When I got here to Colombia in 2014, roughly, the peso is about 1,800 to the dollar. Now it's 4,100. So what that means is that if I bought this water for $1 back in 2014, today I'm buying it for, let's just say, 75 cents. So yes, the dollar has gone down in value if your expenses are denominated in dollars. But if your expenses are denominated in the Malaysian currency, in the Indian currency, in the Brazilian currency, in the Japanese currency, and all of these other currencies, then it's actually increased your purchasing power. So that goes back to the question. So if you're looking at the dollar increasing in purchasing power over the last 10 years, and we all have recency bias, and then you're looking at your local economy and it's going in the tank, where are you going to put your savings? You're going to put it in dollar denominated assets. And if you're going to take risk, sure, there's going to be people that buy Bitcoin and gold and silver. Absolutely. But there's going to be a large number of people, massive amounts of capital. They're going to take their local currency, they're going to sell it by dollars to go into the stock market. So there's never a black and white. That's one of the things that make economics so complex. And that's one of the things for me that makes it so intriguing. You have these thousands and millions of cross currents and variables that are all, playing against each other. And it's your job to determine that which cross current have more power than all of these other cross currents. Which one of these, is it going to be the inflationary cross current or the deflationary cross current that's produced by this or this or this? And that's what makes this game so exciting. On one hand, you've got, inversion of the curve, all these interest rates, all negative interest rate swaps. I mean, you want to talk about a bearish sign, for heaven's sakes. So you've got all these things on one hand that would lead you to believe the stock market could have a tough year in 2025. But then on the other hand, you've got all these other things where it could have a great year because of a TINA trade. How does it all play out? I mean, who knows? I think you just have to go back to the fundamentals of investing and ask yourself what makes the great investors, whether it's Druckenmiller, Buffett, Soros, whatever, what do they all have in common? And number one, they're all going to be experts at managing risk. Number two, they're all going to have an edge. Number three, they're all going to make asymmetric bets. So you have to look around the world or look at your portfolio first and foremost and say, how do I not lose money? Once you figure that one out, and what's my risk management strategy? And then once you figure that out, you say, okay, where do I have an edge? So like as an example, with my good buddy, Kenny McElroy, he's been investing Kiyosaki's money for now decades. So what should Ken do? Well, Ken should look at his risk management and make sure that's airtight. Then he should realize that he's got an edge in multifamily real estate. And then within the multifamily real estate space, he should look for asymmetry. So what he's doing right now, as an example, is he's trying to find all of these deals where the guys got way over their skis in 2020 and 2021, thinking that interest rates are just going to stay permanently low forever. And then all of a sudden they didn't. And you had rents that weren't going up at 20% per year, which was required for their project to actually pencil out. So the project's built $300,000 a door. And now all of a sudden they're screwed because that cash flow will not service the debt. So then you've got Kenny coming in saying, okay, well, I'll buy it, but I'm sure as hell not going to buy it for $300,000 a door. I'll buy it for under the cost of construction. So let's say the cost of construction is $250 a door. So Kenny's coming in at $220. And, the bank's looking at this saying, well, that's unfortunately my best option. Somebody's got to take a haircut here. And then so Kenny's getting that project at under the cost of construction. That's just an example of asymmetry. So what's his downside there? Well, it's very low. What's his upside? Well, it's very, very high. So what we have to do as investors, whether this is with AI, whether this is with gold, whether this is with Bitcoin, the S&P 500, whatever it is, you've got to have those three skill sets. And then regardless of what's happening with the environment or how volatile it is or what Trump's doing, or whatever, as long as those are your North Star, you're going to do well over the long term. I would just encourage people to make their decisions based on thinking and not feeling. To me, this is a time that feels a little bit like a cerveza sickness, where people were making decisions based on feeling as opposed to thinking. When Russia invaded Ukraine, exact same thing. I remember just being yelled at constantly on social media for saying, you know what, sanctions probably are a bad idea against Russia because it's going to hurt us more than it hurts them. But, it was always the rebuttals, well, we have to do something. Well, no, you don't have to do something if on net balance, it's going to be a negative. We all know that weaponizing the dollar isn't a real good idea because that incentivizes countries to look for other options. But what tariffs do is they weaponize the American consumer. But again, it's a trade-off. It's a cost-benefit analysis. It's not black or white. You just have to sit there and list all the benefits of tariffs or any one of Trump's policies, and then list the costs, and then think about it in those terms, where most people do the opposite. They just take a side and they just cherry pick all the data that they want, and then the other side does the opposite thing, and then they just butt heads. And that's not a very good investment strategy in my view. The way tariffs were sold is that it's going to make America great again. It's going to make us rich, is what Donald Trump said. Because theoretically, the way it works is you put up these tariffs with our trading partners, and it makes their goods less desirable to the American consumer. And therefore, you increase demand for domestic products. And then also, as an entrepreneur, you see demand increasing for domestic products. So you start producing more domestic products. And that's how we not only are able to create more tax revenue through these tariffs, we're also able to bring manufacturing back, all these high-paying jobs, et cetera, et cetera. This is how it works in theory. Now, in practice, it didn't work that way, but that's the way it's sold. So the fact Donald Trump came out and implemented these tariffs, I think on Saturday, and then just a couple days later paused them for a month, it's kind of a head scratcher, because if these tariffs are going to make us so rich and create all these high-paying manufacturing jobs, why are we pausing them? Why don't we want that right now? My point here is that I think Donald Trump himself knows that the tariffs don't make us rich, they make us poorer in practice. And he's using this as a negotiating tactic. At least I hope he is, because if you look at all the things, just go through your local Home Depot, just go through your local Walmart or your local Target and ask yourself what percentage of those goods are produced overseas. And then ask yourself, do we have the capacity to produce those within the United States? Do we even have the workers that want to get that manufacturing job? I have someone that works for me. His name is Josh. He's 22 years old. So he really has his finger on the pulse of kind of the intentions or the goals of that. I think that's Gen Z, right? That's all of his buddies and all the people that he hangs out with. They're all Gen Z, so he knows what their objectives are. And I asked him, I said, how many of your friends aspire to have a manufacturing job where they are working in a widget factory on some sort of assembly line? And he said 0. I said, oh, wow, that's surprising. And how many of your people that you hang out with want to create content, want to be a YouTuber, want to be on Instagram, want to do something with social media, or want to do something on the internet, even if it's not creating content? Well, every single one of them. So you see that when the rubber meets the road, it's not as easy as just putting up a tariff and then all of a sudden we're going to be making all these shoes, we're going to be making all of these goods here in the United States. I was listening to my good buddy Peter Schiff, and he brought up avocados. And just as an example of that, that's probably not something that you're going to make in the maybe in California, you could grow them there, but you're only able to grow that in certain areas. And therefore, we have to understand that this is going to reduce the amount of goods and services we have access to. So the comeback there or the rebuttal is always, yeah, George, I see what you're saying, but it's going to increase the wages of American workers, because now, even if we're not producing as much stuff, we're producing more stuff here in the United States, and that is going to trickle down to the American worker, and they're going to have a lot more purchasing power. I think this really puts the cart before the horse, because in economics, one of the most counterintuitive thing, it's so hard for people to get their head around, is that income is not purchasing power. Gold is not purchasing power. Silver, Bitcoin, dollars. It's not true wealth, in other words. True wealth is access to goods and services. Because if you're stranded on a deserted island with a chest full of $1 billion, but all you have are a couple coconuts and some salt water, are you rich or are you poor? You are poor. Why? Because you don't have any stuff. You don't have access to stuff. So when we're trying to think through tariffs, and I absolutely agree that there are trade-offs. This is a cost-benefit analysis. And in a cost benefit analysis, you do have benefits to tariffs. The question is, on net balance, do the benefits outweigh the costs, or do the costs outweigh the benefits, right? And when we're thinking through a proper analysis like that, what we have to do is we have to start by asking ourselves, does this increase the amount of goods and services we have? See, what most people do, their starting point is, well, does this increase American wages? And if this increases American wages, well, then it's great. No, it's not. Because if you just increase wages, but you decrease the amount of stuff, well, what's going to happen? The purchasing power isn't going to go up, because prices are going to go up. And to a point where the margins shrink for the producers in the United States, and then they're going to have to start laying off workers, and that doesn't increase purchasing power. So there is no net benefit to the American worker unless you're creating an environment, a society that has access to more goods and services. So when we're thinking through tariffs, with Canada, Mexico, China, wherever these tariffs are targeted, we just have to start by asking that question. Is this going to result in the short term, midterm, long term with us having more goods and services or less? And usually, if you're being honest about it, the answer is obviously less, even if you have some of those goods produced in the United States. So that's why I really hope that Trump is just using these as a negotiating tactic. Donald Trump, I think, has done some amazing things, but the fact of the matter is he's a bull in a china shop. That's one of his superpowers. That's one of the reasons why he's such a good negotiator. But I have no idea what he's going to do because he's constantly contradicting himself. I mean, just the other day he came out and he said that through a tweet, he's threatening all of these countries that are potentially going to use the BRICS currency. He said that they better not do that or else they're going to get like a 100% tariff. Right. And while at the exact same time, he is telling everyone that he's a huge proponent of cryptocurrency and Bitcoin. It's like, how do you square that circle? Because you're threatening people who are jeopardizing the future of a monetary system that's dominated by the US dollar. But yet, on the same hand, you're trying to empower people that are building products that are intended to threaten the dollar. You're threatening people to don't stop using the dollar, I assume, because you don't want the dollar to go down in value relative to other currencies, but you don't want the currency to collapse. But at the same token, you want to bring manufacturing back to the United States, which a lower currency would be a tailwind. So it's kind of like a push-pull. If you have higher currency, then that's going to be a headwind for manufacturers that would likely offset any tailwind that was created by a tariff. So again, I'm just going on based on what he's saying. And every single time I listen to him, he's contradicting something that he said like 5 minutes ago. I can't remember a time when there were more unknowns than maybe March of 2020, for obvious reasons, back then. But today there are almost as many unknowns. And with the exception of, we'll call it the cerveza sickness, I think we're at an all-time high, at least since I've been creating content or even been thinking about this stuff back in 2012. Most likely it's going to be volatile. I mean, we can see in the market today, it was down, I think 600 points to open. And then when he came out and he took back the tariffs and he pressed the pause button for a month, now all of a sudden the market's down maybe 200, maybe it's flat. Who knows, it might close up. So I think that what most investors should factor into the equation is that 2025, whether we end the year higher or lower with specific asset prices, it's most likely going to be far more volatile than what we have seen over the past couple of years.